Good morning, David. My name's Karen Guch. I'm the Global Head of Private Equity at Baker McKenzie. I'm delighted to have you here this morning at the podcast. We've just come off a fabulous panel with some of our other colleagues, and we've covered a wide range of topics during the session, but we only had 30 minutes and did a whistle-stop tour across the different issues. And I'd love to delve a little bit deeper into some of them with you during the session. And maybe the best place to kick off and do a bit of scene setting is on the geopolitical and macro environment and what that's doing to our industry. Now, again, as I said, we had a very high-level conversation about it. I think the conversation earlier was very much focused on sort of deal activity. But I wonder, sort of kind of closer to home for you, how you see that's being impacted by what we're living through at the moment.
Yeah, sure. Well, pleasure to be here together. And maybe by way of quick introduction, my name's David Atterbury. I'm part of the team at HarbourVest. I've been with the firm for 21 years now, and I manage our business here in Europe and the Middle East, but also my main role is helping to lead our global secondary business. So we obviously have an interesting vantage point in terms of looking across the whole of the PE landscape on a global basis. And so hopefully I can share a few themes top down. And Karen, to your question around macro environment, etc. I mean, maybe to kick off, people talk about macro and impact on investing, and ultimately, I think our view is that Europe private equity is not really a macro play. Mm-hmm. So it's not really about market beta. It's about creating value on a micro basis in the underlying businesses that you invest in. And if you step up to the big picture, you think about US public markets, European public markets, mm-hmm. and clearly there's a disparity in terms of performance for a period of time, and intuitive to me that feels a little bit more correlated to macro. There are other factors going on, of course, in terms of US markets and technology, etc. But there's an element of macro there. You look at private market performance, and top quartile returns in Europe are at very similar levels to US. Pooled returns are at very similar levels to US pooled returns from a private markets perspective. And so the first thing that says to me is, if you want to play Europe, private markets is the place to be. Sounds slightly self-serving. We're here, it's a private markets discussion. But that feels as if that's where the return opportunity is. And so why is that the case? If you drill down, I would say there are three big themes that European PE has been investing behind now for a period of time. And if you go back 20 years, 25 years, 30 years when I first got into the industry, it was way more about generalists. And today, the European market is very much about sector specialists, even on a pan-European basis. You have some local country specialists, but at the mid-market and big end, it's more about sector specialists. Mm-hmm. What have those sector specialists been doing? What a real theme of consolidation across fragmented European markets. We all know that each of those local markets is very different in terms of local culture, language, approach to doing business. And you see that strategy play out with our pan-European managers. And so consolidation is a real theme. If you look at activity levels last year, somewhere in the region of 2/3 of deals were add-ons. Points to consolidation. 50% of deals were cross-border deals. Points to consolidation across market, and this theme of creating essentially European champions that can then kind of play on the global stage. And so you see that happening across the marketplace. Yeah. I'd say the other theme, or one of the other themes, is digitisation.
Yes.
So spend on technology across the European landscape, probably somewhere in the region of 50% of the spend in the US in terms of tech spend. There's a big opportunity there for digitisation in Europe, and European PE is investing behind that theme. So capitalising in software. Obviously some challenges with terms of the market perception today, real time, but investing behind software, investing behind cyber, kind of increasingly investing in the AI wave. So that theme of digitalization has been a real driver of European PE. And then I would say the third theme that we've seen play out for many, many years now, and it's a little bit more at the smaller end of the marketplace, is the professionalisation of founder-led businesses
Yep.
and tapping into local markets, finding those founder-led businesses, professionalising them, bringing in new structures, new systems, and creating value, and probably creating the feedstock for the consolidation at the bigger end of the market that I talked about. And so those three themes have driven a lot of those private market returns
Yeah.
for many years now. So where does that leave us today in terms of what is clearly a challenging geopolitical macro environment? I think we've got a little bit used to that uncertainty.
Trying to navigate that, yep.
It's been around for a long period of time. I think one of the biggest challenges in private markets is uncertainty around interest rates, and with more stability in interest rates, it means that people can push the button on deploying capital. And we've seen that happen. So where
Do you
are
think
we
we're
today?
entering that era now?
Well, cautious optimism,
Yes.
I would say. Liquidity levels were up.
Yeah.
Up across the whole market last year.
Yeah.
When we look at our portfolio and think about essentially the conversion rate of NAV into distributions as a measure, if you go back 5-6 years globally, that was probably in the region of 20-25% of NAV was turning over. So implies a 4 to 5 year hold.
Yep.
That's probably now 10 to 15%, which implies 6-7 year holds,
Yeah.
which we're seeing across the whole market.
Yes.
Actually, when we look at our data for Europe, it's a little bit higher in terms of that conversion rate than it is for our global portfolio.
Okay.
So it points to a little
Okay.
bit more liquidity coming through in Europe.
That's healthy.
Deal activity improving generally.
Yeah.
And actually, interestingly, if you look at the fundraising stats for Europe last year, fundraising for the mid-market and small cap actually hitting record levels. So funds below 5 billion euros in size, record levels of fundraising, lots of oversubscribed mid-market small cap funds. And actually we see somewhere in the region of 80 to 90 small cap funds raised each year in Europe, so $200 to $300 million. So long-term allocators are seeing an opportunity set in Europe, partly driven, I think, by a view as to, is the US the place to invest or not? Mm-hmm. When you ask that question is, where else do you invest?
Yeah.
So certainly from where we sit, we're not seeing people moving out of the US, but do you tweak your allocations? Do you go 60 to 58 or 57 and add a little bit more into Europe? That feels to be, there's an element of a theme there. Where's it going? It's going into mid cap and small cap. And then the question is, what are those managers doing? How are they responding to the environment we're in? Well, we have the privilege of looking across the market. So we have a CRM system. Essentially, we treat our underlying general partners, the people we invest with, like clients. We have a CRM system. We manage those relationships very carefully. We can look at the themes that are coming through in all the interactions that we have. And I would say, really can boil it down to four themes people are talking about across the marketplace today. One is the kind of notion of B2B investing, mm-hmm. and that's a little bit obvious. It's a little bit where the market's been, and so I don't think there's a big revolution in terms of investing approach. It's more evolution of strategy, mm-hmm. but that focus on contracted recurring revenues in the B2B space. It's a focus on business models that are embedded, where there's a real necessity on the part of the customer rather than it being discretionary spend. It has been software, it's fund administration, it's regulatory and compliance businesses, it's testing and inspection. And interestingly, increasingly, infra-adjacent servicing businesses.
Okay.
So you see that underlying infra cash flow, you look at the servicing businesses around that space. And so for the bigger players, upper end of the mid-market, the bigger players, that's a real theme and a continuation of an evolution. As you look then in other areas of the marketplace, I'd say next on the list has been that professionalisation of smaller businesses. That's playing out, but increasingly when we look across our managers, the push from the founders is to move away from some of the kind of pref equity type solutions where they're subordinated in the capital structure and looking for more partnership models, more governance-led deals where they're working alongside a financial sponsor as a partner. Yep. And so that points to relationship building. It points to local language capabilities for the smaller cap managers in regional markets and country markets, and about succession planning. And to my mind, that points to those founders probably having an eye on the macro and not wanting to be subordinated, but wanting to grow alongside rather than being in that subordinated position. So I'd say that's theme number 2.
Okay.
Number 3 has been carve-outs.
Yes.
People talking about carve-outs. 1 in 10 deals last year in Europe was a carve-out.
We've done loads of carve-outs in the last few years. Yeah.
And there again, it's that theme of looking to create alpha through unlocking of operational complexity. So it's not about riding a macro wave. Yeah. It's about finding an asset probably now where there's good visibility post-COVID in trading. So you have a good sense that you've got a good economic proposition there. Yeah. Business may well be lacking discipline under its current ownership, and you create your value, create your alpha through the unlocking of the deal, the unlocking of the asset, and helping it to flourish on a standalone basis, rather than it being about multiple expansion, leverage, or top line growth necessarily. And then I would say the other theme that we're hearing across the marketplace is a move away from kind of healthcare growth, for want of a better word, to healthcare infrastructure and plumbing. So a little bit of the picks and shovels mentality, I guess. And again, that theme, when you think that through, it's less about revenue growth, taking risk on R&D, so less volatility in the top line. It's more about clinical data management, administration platforms, roll-ups, those types of things where you have more predictable top line, a slightly more defensive top line, and you can focus on the business, building the business, growing the business, maybe through acquisition or through operational improvements. And so when you put all that together, those themes are really, as I say, a little bit more of a evolution rather than a revolution in the context of the overall macro. But it points to that thesis around European PE not being about multiple arbitrage. Certainly in mid-cap, small-cap, it's less about leverage than it was historically. Yep. It is about driving value in the underlying businesses and capitalizing on inefficiencies in the marketplace. Yeah.
I mean, as a secondaries player, how do you play a role in value creation in portfolio companies?
So as a secondary player, the core value proposition for us to our investors ultimately is about unlocking assets and asset selection, and working and choosing the very best managers who then drive that value in those underlying businesses. So for us, manager selection is absolutely key. So when we are considering a transaction, our first question is, who's the manager and what are the assets? And that sounds slightly trite. Everybody wants to buy good assets and work with good managers. There are secondary buyers who have a different strategy, where they may be buying older assets, tail ends. They're looking for bigger discounts. They create their value in a different way. For us, the vast majority of our value creation, somewhere in the region of 85-90%, comes from the appreciation of the assets post-purchase. It's not about discounts. And so the value proposition to our clients is manager and assets. Yep. And in picking the right managers, we're obviously choosing managers that we think have replicable strategies in terms of value creation in the underlying assets. Now, sometimes, from our perspective, we're then providing the capital to make that happen, and we're backing the managers into value creation plans, add-on expansion strategies, etc. But most of our proposition comes from that capital provision and the unlocking of the assets, and then seeing the assets flourish under the new managers. Now, that is increasingly, when you think about secondary market, in the form of continuation vehicles. Yeah. So somewhere in the region of half of the market.
I was just going to ask you about that, because there's such a huge growth in that in recent years, and it's accepted by the market now.
Yeah, very much. And that is where I think managers see the opportunity to double down on assets and really build on value creation plans and extend the ownership period. And when we were talking on the panel, there was a discussion around operational improvements, and we obviously watch our managers go through their playbooks, and starting early, as was discussed, is absolutely fundamental to that process. It's getting it embedded in the culture, it's having the right team in place, it's the technology plan. But having access to liquidity is also part of that. And so we're seeing the increase of continuation vehicles where that valuation plan can go from point A to point B, and then the manager says, well, look, we're at point B. There's a very clear journey to point C. Investors have been invested now for 5, 6 years, 7 years potentially. Let's offer them the chance for liquidity, and let's use secondary capital to move it on to the next level. But what we're also seeing in the marketplace, interestingly, is a rise of essentially midlife co-investment as well, where managers, rather than using a continuation vehicle, are saying, look, we've taken the business from A to B. We have generated a nice return so far. We're sat on a 2x, 3x money multiple. Let's bring in a partner into the business as a co-investor, and we'll use that capital as essentially a primary capital raise to help fund the growth to the next level, to help fund an acquisition. And so we're increasingly seeing that phenomenon in the market with a real increase in that type of midlife co-investment deal flow happening, with managers using it to extend that value creation process and that operational improvement process.
And are you still primarily focused on private equity assets, or are you looking at other assets as well in infrastructure and, maybe, I don't know, credit, real estate?
So for us as a business, our focus is on the alternative space, with the exception of real estate. So we do cover private equity, credit, and infrastructure.
Okay.
And there are similar themes playing out, certainly from a secondary perspective, across all of those parts of the market. And if you think about all the alternative space, the vast majority of capital flows are primary issuances, essentially. That's unusual. Most other markets, you have a primary issuance, and then the secondary volumes outstrip primary volumes.
Yeah.
Private markets, it's the other way around. Does that make sense? As the market scales over time, it feels unrealistic to think that every privately held asset can be IPO'd, can be sold to a trade buyer. And historically, we had the concept of secondary buyouts, so sponsor-to-sponsor deals. Increasingly, secondary liquidity is a fourth exit option for GPs.
Is that a sign of a weak market, do you think, or
I think it's the sign of a maturing market.
Okay.
And so that notion of injecting liquidity into the asset class, as I say, that's a feature now increasingly across credit, where credit secondary is growing as an opportunity set. The infra secondary market is probably 10 years behind the private equity secondary market, and obviously the private equity secondary market is now growing dramatically, and it was $220 billion or so of transactions last year, up 35% or so. So I think it's a sign of maturation of the markets and that move towards a more liquid marketplace. And historically, the whole space has been essentially constrained through fund structures, which in theory are 10 years. We all know they never really last 10 years. It's probably more. So it's a slightly artificial construct that constrains, and it constrains managers in terms of holding good assets, and it constrains investors. So why would we not see secondary liquidity, whatever form it takes, going from 3, 4, 5% of the market to significantly more over time? Now, I don't know what that looks like in 20 years' time or 10 years' time if it's the same, but the continuation vehicles are the start of that journey. So we're probably 10 years into that journey now. Last year, somewhere in the region of 20% of liquidity that general partners created came through continuation vehicles. So it's very much an exit route, an exit path, a liquidity path that feels here to stay. Now, does it stay at 20% if all those other channels start to really open up? Maybe that percentage goes down a little bit, but it's here to stay as a structural phenomenon. And so that same theme exists in infra. Even longer dated assets, why would you have the constraints of a fund life? Greater and greater liquidity coming through the infrastructure secondary market. And I think increasingly we're seeing that in the credit secondaries market, where we're also active, and you see increasing numbers of deals come through, both in terms of more LP portfolios, but also continuation vehicles. So a significant volume of continuation vehicles in the market today, even in the credit secondary space, where general partners look at their books and say, look, we've got performing assets. Actually, our investors invested with a certain view of the time frame for liquidity. Let's give them the option. And investors can pick and choose. They can roll over, they can stay invested, or they can take the liquidity. And so I think it's a good tool and it's good practice. And I think it points to, as I say, maturation and essentially better fund management, rather than it being a kind of challenge for the industry.
And it sounds like the relationship, I think, with managers is also improved in that they no longer see, as an investor in a particular asset or in a fund, I think in the past, when someone wanted some liquidity and needed to exit, it was a bit of a pain to deal with them and think, oh, now I've got to find someone else to come in. I've got to check that they're creditworthy and all of that. Whereas now I think they seem to be sort of better prepared and actively go out and offer investors an alternative and bring you guys in. So that's it. As you say, it feels like a maturing market. And to give them the added liquidity and flexibility around the timeline.
Yeah, I think that's right, and it's a little bit of a cliche, the whole win-win-win type mantra.
Yeah.
But cliches are often embedded in truth, I think, indeed. And that's where they come from. And so, historically, general partners, it was a hassle. I guess, a secondary trade. Yeah. Whereas today, I think general partners are increasingly strategic around how they think about the secondary market, recognizing that maybe they do need to offer some structured liquidity to their older investors, recognizing that their older investors in selling may well then re-up into the new fund.
Indeed.
And so they can be strategic in terms of how they use the secondary market, who they want to partner with in the secondary market as a buyer.
Yes.
And then that same theme extends to the continuation vehicles. And if you think about it, you've got investors in the asset class, long-term allocators. I talked a little bit about that conversion rate of NAV into liquidity that's down at 15%, 10-15% or so across the market. If you look at long-term cash flow experience for investors in the asset class, historically, go back 5-6 years pre-COVID, investors were generally cash flow positive.
Yeah.
Distributions outpaced capital calls.
Yeah.
Last few years, that's probably gone negative.
Not the case, yes.
And so those LPs who are saying, okay, let me use the secondary market to generate liquidity. And it has been a push for liquidity over the last couple of years on the part of sellers. We had the denominator effect when public markets went down, public markets back up, less of a challenge in allocations, more of a liquidity squeeze. Those same LPs may be selling an LP interest, but they're also knocking on the door of general partners saying, where's my DPI? And general partners are then using the market. So it creates, it is that oil in the system.
Nice little ecosystem.
It is creating the liquidity. Yeah. And again, coming back to my point earlier on, why should all private assets move out of private ownership? There are perfectly good homes for those assets with people who want the exposure. And so it's oiling the wheels and helping the system turn through that injection of liquidity.
Yeah. I mean, I'd like to also explore with you what role you think private capital, wealth funds, etc., play in this same ecosystem.
Yeah. Well, so it's as I talk about that injection of liquidity, obviously it points to increased liquidity in the marketplace, capital coming in, and on one hand, I think the obvious question is, well, what does that do? Influx of capital into the market. What does that do for pricing, for example? And I think when you look at the scale of private markets relative to public markets globally, I think I've seen a report that suggested somewhere in the region of 10, 12 trillion or so of private market assets. If you add up all the dry powder and the NAV and a little bit of the shadow capital that's out there, it's that sort of scale versus somewhere in the region of 100 trillion for public markets. 10 times. Why should it be 10 times? Yeah. There are huge volumes of privately held companies that aren't in under the ownership of private markets firms, but are just out there. And so there's a huge opportunity set for private markets to grow. And I talked a little bit about those founder-led businesses, which is obviously the feedstock for the industry in terms of it moving through the ecosystem. So I think if that wasn't the case, I think it would be very reasonable to say inflow of capital, what does that do to long-term returns? But I think in the near term at least, is that 5 years, is that 10 years, is that 20 years, I think there's room for the industry
adds to the health of
to
our
grow,
business.
adds to the health of the business. Now, what you do see in different parts of the market are impacts from that capital coming online at the different points. And there's been a little bit of talk in the secondary market around capital coming in, a little bit of talk around some buyers paying a premium because they've got an inflow of capital into an evergreen vehicle. My sense is that it tends to be around the smaller end of the marketplace. So those vehicles, when they take capital on initially, are they better off holding it in cash, or are they better off investing it into a diversified portfolio where they make that investment decision? But it's rippling through the smaller end of the marketplace. The importance for those vehicles in terms of investor experience is having a very big deal funnel, diversified portfolio, and for the manager to have that deal funnel that means that you have great investable opportunities kind of month in, month out, so you can get the capital deployed and you don't have to overpay for particular assets. So there's a little bit of that happening. I think we see it periodically in the marketplace. I think the other theme or area for concern is probably what does it do to the kind of bigger end of the market in terms of co-invest flow? You look at some of the bigger managers, they're raising big evergreen vehicles, they're investing it into their direct strategies. Is that going to mop up some of the co-invest that they offer to some of their clients? I think that's something to watch out for. I'm not necessarily saying that that's happening today, but I think it's something to watch out for the longer term as to how it hits. But I do think the industry, as I say, is really positioned to take that capital in and by and large deploy it appropriately in interesting opportunities and preserve the levels of returns that we've seen historically.
Fascinating. Thank you, David.